You might not always see them, but the world absolutely runs on logistics. I mean, from the raw materials leaving a mine to that package arriving right on your doorstep, it's all about moving stuff around. And this vast network of real estate, the warehouses, the distribution centers, they are really the fundamental backbone of global commerce. So today, we're going to pull back the curtain a bit on this unseen but totally vital sector. This deep dive is all about the latest insights from a major player in logistics real estate, Prologis. We'll be breaking down their second quarter 2025 earnings call and their detailed financial report.
Yeah, and we've got the goods. We have the full transcript of that Q2 2025 earnings call. You heard from their CFO, Tim Arndt, CEO Hamid Moghadam, President Dan Leder, and Managing Director Chris Caton. Plus, we have their comprehensive financial results report, too.
Exactly. And our mission here is, well, pretty simple. We want to extract the most important nuggets of knowledge, maybe some surprising facts too. The goal is to help you become, really well-informed about the current market conditions, the customer trends, and the strategic direction of this whole industrial real estate sector.
Yeah.
We'll try to cut through all the complex financial jargon that often comes with these reports. Okay, so with all that context about how vital logistics is, how did Prologis, this global giant, actually do in the second quarter? The numbers they put out tell a pretty compelling story, I think. Resilience, strategic positioning, it's all in there. Their period-end occupancy hit an impressive 95.1%, which means they basically outperformed the broader market by a significant 290 basis points. That's nearly 3% higher occupancy than average.
Yeah.
Shows their competitive edge.
Definitely. That's a strong number.
And they also saw what they call meaningful rent change. They delivered 53% on a net effective basis.
Right, which considers the whole lease term.
Yeah.
Exactly. And a solid 35% on a pure cash basis. And that distinction matters, doesn't it? The cash figure is the immediate income boost, while net effective is the bigger picture.
Precisely.
And then looking at their core financials, their core FFO, funds from operations, per diluted share was $1.46. That's up 9.0% compared to last year. And FFO is, that key metric in real estate showing cash flow from operations.
Yeah, it's what everyone watches.
Right. And excluding net promote income, those performance fees they get, sometimes it was $1.47 per share, still up 8.1%. Plus, cash same-store net operating income growth came in at a solid 4.9%.
Those numbers are certainly impressive, yeah. Especially, given the market headwinds we've seen. But what's truly illuminating here, I think, and what Prologis' CFO, Tim Arndt, pointed out, is how these results really show their underlying resilience. He mentioned the strength and versatility of our team and portfolio, which suggests, their strategy, where they place their assets, their operations, it's all helping them weather these market ups and downs. But for me, a key detail that really shines a light on their future earning power, it's their lease mark-to-market. It stood at 22% at the end of the quarter.
22%, wow.
Yeah, I mean, this isn't just like vague potential. It's a massive built-in growth engine. It basically means nearly a quarter of their current leases are significantly below what the market is charging now. So as these leases expire and renew, Prologis can capture that 22% average uplift. That gives them a really robust, almost guaranteed tailwind for their financials, even if market conditions get a bit choppier.
Okay, so that's the financial picture. But as I was going through this report, one part genuinely jumped out at me as really insightful. It was this clear shift in customer psychology. Prologis highlighted that their largest customers, particularly, are now increasingly looking past the headlines. They're moving beyond the noise of the constantly changing news cycle. They're describing an emerging bias towards action. And they quoted one prominent user who put it perfectly, talking about the exhaustion of adapting to shifting tariffs and just needing to run their business. That really resonated, with all the challenges businesses have faced. But what does this emerging bias towards action actually look like in practical terms for Prologis? How does it translate into their pipeline? Is it just pent-up demand finally breaking free, or is it something more fundamental?
Well, I think that's a critical distinction. And Hamid Moghadam, their CEO, had this perfect analogy for it. He said it's like water building up behind the dam.
Ah, okay.
So it's not just a simple need for space anymore. It is indeed this growing inability to keep putting off crucial long-term strategic decisions. I mean, while overall net absorption, that's new space leased minus space vacated, was subdued, it's really significant that their leasing velocity actually accelerated over the months of the quarter. June was the strongest month.
So things picked up towards the end of Q2.
Exactly. which points to that pent-up demand starting to flow, just like the water analogy suggests. And the leasing pipeline itself, it's reached historically high levels. We're talking 130 million square feet. That's an impressive 19% increase year on year.
Wow, 19%.
Yeah. So it reflects both significant interest and need for space, but it also kind of suggests that companies have maybe exhausted their other options. Like using that existing gray space, underutilized space in their own facilities, or leaning really heavily on 3PL capacity, third-party logistics providers. At some point, as Mogadam put it, companies just can't basically go to sleep without taking more space. They hit a wall where putting off decisions becomes more costly than just moving forward.
Right, they have to act eventually. Okay, so this deep dive also shows Prologis isn't just focused on traditional warehouses anymore. They're making some pretty significant strategic plays in adjacent sectors, especially data centers and energy solutions.
That's a big shift.
Yeah, they had their largest start to a year ever in development, totaled $1.1 billion just in the first half of 2025. And a substantial chunk, 65% of their Q2 development starts, were build-to-suit projects.
So built for specific clients already lined up.
Exactly. Custom designed, pre-committed. And a notable $300 million of those starts went to an incremental investment in our ongoing data center development in Austin, Texas, with a top hyperscaler.
One of those massive cloud computing companies needing incredible amounts of data capacity.
Right. Huge power users.
Totally. And it doesn't stop there. They've been actively procuring power. They added another 200 megawatts MW in Q2. That brings their advanced stages category for data centers to 2.2 gigawatts GW, with another 1.1 gigawatt fully secured and 300 megawatt actually under construction.
Those are enormous numbers. A gigawatt powers hundreds of thousands of homes. It's mind-boggling. And in their energy business, they're on track for their goal of 1 gigawatt of solar production and storage. They've got nearly 1.1 GDVW in operation or under development today. You mentioned earlier that power jump for automated facilities from 5 kilowatt hours per square foot to maybe 25. That's huge. It almost sounds like they're becoming a utility company on the side. So how are they navigating this, power-constrained environment? Are they essentially becoming their own energy providers?
Well, that's not actually too far off, and it's precisely why this is such a crucial, really strategic play for the future of industrial real estate. Like you said, warehouse automation drastically increases power demands. Regular warehouse, maybe 5 kilowatts per square foot, fully automated, maybe with EV charging, could be 25 kilowatts.
5 times the power.
Right. So Prologis is proactively tackling this power-constrained environment. They're developing what they call a behind-the-meter energy generation solution using microgrids. Think of a microgrid as like a localized power system. It can operate on its own or connected to the main grid. It gives more reliable, resilient power. And their president, Dan Letter, highlighted this as a very strategic growth area.
So it's a solution for their tenants, but also a business line for them.
Exactly. And also, while some recent U.S. legislative changes might reduce solar incentives a bit, Prologis expects the sort of resulting upward pressure on energy prices to uphold returns. Basically, if energy costs rise for everyone else, their ability to provide these integrated energy solutions becomes even more valuable. It helps maintain their margins.
Interesting hedge there. Okay, so despite some talk, maybe some headlines about choppy conditions for the next few quarters, Prologis is clearly signaling confidence in the market's underlying strength and its future path.
Yeah, the tone was definitely confident.
In the U.S., they noted net absorption was subdued at 28 million square feet in Q2. Market vacancy ticked up just slightly, 10 basis points, to 7.4%. However, Prologis sees an over 20% spread between current market rents and what it costs to build the replacement cost rents.
That spread is key.
Right. They see this as basically the profit margin for building new facilities. If rents are way higher than the cost to build, it's a huge incentive for future development. They called it an important precursor to the next cycle of market rent growth.
Makes sense. It signals future potential.
And they backed this up with action. They narrowed and increased their full-year 2025 guidance. Average occupancy projected between 94.75% and 95.25%. Rent change expected in the low to mid-50s% range. Core FFO, excluding promotes, guidance is now $5.80, $5.85 per share. That's a $1.45 increase from their prior guidance.
A pretty significant bump.
Yeah. And development, so its guidance also increased to $2.25 billion to $2.75 billion, driven by those data centers and build-to-suit deals. And crucially, their balance sheet looks really robust, over $7.1 billion in liquidity at quarter end. Plenty of dry powder.
Financial flexibility is huge right now.
So it's certainly reassuring to hear that 7.4% vacancy is considered normal in historical context, like Hamid Moghadam pointed out. But, for some listeners, that number still might feel a bit high compared to the super tight markets we saw recently. Are there any specific, warning signs or areas of concern within that overall picture, or the path really clear towards that magic 5% vacancy rate they mentioned?
That's a great question, and it really gets to the nuances within the market. Because while the overall picture looks strong, it's true, not all markets are seeing the exact same thing. But from that broader perspective, yeah, 7.4% U.S. market vacancy. While it's higher than the last couple of crazy years, it is pretty normal historically. Like you said, CEO Hamid Moghadam pointed out that 44% of the time over the last 25 years, vacancy rates have actually been higher than this. So it's not exactly an alarm bell ringing.
Okay, good context.
And he also highlighted something really interesting about bad debt, tenants struggling to pay, even with a slight increase in that, because Prologis' ability to release properties at much higher market rates has been so strong. On the whole, the financial gains from getting a new tenant in at today's prices have actually outweighed any losses from the default. He called it NPV positive in aggregate.
So even a default can sometimes turn into a net positive for them financially. That's kind of counterintuitive.
It is, but it speaks volumes about how much rents have risen, that massive mark-to-market potential we discussed. Plus, you have this depleting supply pipeline, not as much new construction starting up. That's setting the stage for tighter conditions down the road as demand eventually picks back up. So yeah, it really is a picture of underlying strength beneath some of the short-term noise.
That's a really helpful perspective on the overall market. Now, let's maybe zoom in a bit. Are these trends playing out uniformly across all geographies?
Yeah.
Or are there specific hotspots or maybe some cool zones within this global logistics map?
Great question, because understanding those regional variations is key. Definitely seeing international markets showing outperformance, particularly in Europe and Latin America. Places like Mexico City and Sao Paulo were mentioned as doing really well, even better than the strong overall trend.
Okay, so international strength. What about the U.S.?
In the U.S., it's a bit more mixed, but still generally positive underlying trends. Some coastal markets, like Southern California, have seen some weakness, but Prologis expects them to bounce. The CEO called it an exaggerated bottom, and the opposite of FOMO.
Opposite of FOMO, fear of missing out on the next cycle.
Exactly. Rather than fear of missing out on space now, maybe there's been an exaggerated dip, and soon companies will fear missing out on locking in space before the next upswing. Other U.S. markets that are showing more resilience or stability include Southern Florida, Washington, D.C., Indianapolis, which they noted is strategically working through some excess supply, Dallas, where submarkets are firming up, Houston, Nashville, and Atlanta.
So a range of resilient markets across the country.
Right. So while there's definitely some short-term choppiness, mostly due to policy and general macro uncertainty, the long-term fundamentals for well-located logistics real estate look really strong. Hamid Moghadam, the CEO, views the business as growing, like 1.5% to 2% normally, and he expects really good pricing power, above inflationary pricing power, once that vacancy rate comes down towards 5%. He referred to 5% as historically being the magic number for strong rent growth.
The magic number, okay.
And this whole outlook is underpinned by some powerful long-term drivers. Things like a shortage of labor coming up in the construction industry, which pushes up costs. Government spending on things like chip plants, driving demand for more industrial space nearby. And of course, those rising demands from data centers and automation we talked about. All these things contribute to increased construction costs and likely future rent growth. These are pretty powerful long-term forces that kind of transcend the immediate market chatter.
Okay, so wrapping this all up, what does this deep dive really mean for you listening? Well, it shows us a really resilient industrial real estate sector. It's not just, holding steady. It's actively evolving. Key players like Prologis are making these big strategic long-term investments. They're responding to fundamental shifts in global commerce and technology. It seems like they're seeing past the current headlines and really positioning themselves for a future where supply chains are even more critical and the demand for these advanced, power-hungry facilities is just going to keep growing.
That sums it up well.
So here's something to think about. If leading logistics real estate companies like Prologis are confident enough to pour record amounts of money into custom-built projects and these massive energy solutions, actively positioning for future demand that they see building up right now, what does that tell us about the supply chain's inevitable growth trajectory, regardless of today's headlines? It kind of makes you wonder if the current uncertainty we hear so much about is really just a pause before the next big acceleration in logistics demand.